Good day, fellow investors. Ray Dalio recently made an interview podcast on his Bridgewater channel discussing the most important thing when it comes to investing in this environment, which is zero interest rates and all the consequences that come along. They made a 30-minute interview. I'll try to summarize that, add the visuals, which they haven't done, that will give you a better picture on what's going on and on the most important thing you have to watch when it comes to investing now. I'll also end with my opinion. So this is the key. We had the past paradigm, now a paradigm shift, lower rates and quantitative easing for the last 10 years. This will turn into even more money printing, direct money printing to ease the high debt levels from government to corporations, and that will result in lower returns in all asset classes. He expects zero returns in asset classes, and we will see whether asset prices will go up like it was the case over the last 10 years, or we'll see nominal asset price increases and negative or zero real returns. This is the environment. Let's start by discussing one by one what Ray Dalio sees. So from the monetary environment we have been living in over the last decade, and we are likely going to continue to live in, we have zero interest rates. So really zero interest rates. If you go to a bank, what you get is zero, and that is the most important factor investors have to watch, according to Ray Dalio, when it comes to investing, because the zero creates the fundamentals, the basis on which everything else is priced. And in this video we're going to discuss how we came to this environment and then what is to be expected later. So from the environment, portfolio solution, and then you have a decision whether you want to be like Ray Dalio or you want to be more an investor like Warren Buffett. So what to expect over the next decade? We have, first, over the last 50-60 years we have had declining interest rates, then the Fed buying assets, and now printing money and buying bonds directly to finance deficits, both corporate and government. This is how crises are solved, and this is why you have to keep an eye on what's going on. So, as we said, first monetary policy, lowering interest rates to ease the situation. Interest rates have been higher up till the 1980s, and since then have been constantly lowered to ease the debt burden, and especially over the last decade. And if we look at what are the interest rates, the 10-year maturity for the US government treasury, the yield now is 0.64%. So if you invest 1 million in US treasuries for 10 years, you get 6,400 per year, and then you get your million back in 10 years, whatever the million will be worth in real value. So interest rates, we can say, have hit rock bottom. The second way of monetary policy too is when the central banks step in and start buying assets. That has happened since the last crisis in 2009. The Fed's balance sheet has really exploded, especially now with the COVID crisis, and we are 7 times what it was just 11 years ago. And it is likely that it will continue to expand and significantly expand over the next decade. So that's monetary policy 2, and now 3, where they are directly printing money and buying and financing the deficits and giving money to people directly, which is monetary policy 3, to finance the huge government and other debts that are creating a situation where it could lead to a liquidity crisis, a depression, but that will not happen because they are printing money as said. The environment is such that there is not enough income to finance the debt burdens. So the only solution is or default. Nobody's going to default, nobody wants to default. So the other solution is simply to print money as much as you can print and even trigger inflation to ease the servicing of the debt. When you see such big debts, 22 trillion, then people think, when are they going to repay it? Never. debt is not there to be repaid. It's not like you going to the bank and you have to repay your debt. Governments, corporations, their intention is to never repay the debt. Keep that in mind whenever you hear about big debt piles. So how is that going to be dealt with? With printing of money, real interest rates are going down, inflation will likely rise according to Dalio over the next decade, and money is going into real assets for wealth protection. So we might see low interest rates, but zero interest rate is not a floor for central banks. We have to differentiate between nominal and real rates, and real rates can really also go negative. If we look at the 10-year treasury that we already mentioned, but adjusted for inflation, we see here how it is in negative territory. So the person investing $1 million into the US Treasury will have certainly lower purchasing power in 10 years because his real return is negative. The situation is that governments, investors, companies don't have enough money in relation to their needs. Countries are not able to service the debt obligations, but then we said no default. Money printing is the solution, and a lot of money printing according to Ray Dalio. Let's go on to investing. So the current paradigm that we have lived in from 2009 to 2020, and Ray Dalio says we are not getting another round of what has been going on, which is quantitative easing, lower interest rates, a lot of liquidity, alongside tax cuts, and a lot of company buybacks that have pushed stocks up. So we are not getting another of those, and that's why we might see zero or negative returns over the next decade. So on cash, thinking that cash is a safe asset is tragic according to Ray Dalio, because they are printing so much money. You haven't experienced this in your lifetime, which means it will be a surprise to many that hold cash. Cash is losing purchasing power and value fast. And the only way out is to print more cash. So this has happened always in history, and currencies are sacrificed from a real perspective, from a real value. Something to keep in mind. On equities or investing in risky assets, the expected return on stocks is essentially around zero at the current moment, which is still better than 10-year bond, where the real return is expected to be definitely negative, especially if inflation goes up. The key is that company borrowing costs, government borrowing costs, compared to the return on the equity, on the capital they are investing, is really, the spreads are getting thinner and thinner as many are chasing investments, are chasing the yield, which leads to zero returns over the long term. That's a fact of life we have to deal with when it comes to investing. Asset classes are affected by monetary policy, no more interest rates, no more lower interest rates, so there is not much that will push asset prices, real asset prices, higher, except for inflation. Today the markets are driven by central bankers. How they do that will create volatility. So when the Fed doesn't react immediately, we see a lot of crashes. When the Fed reacts, we see a recovery. So this is what happened with money printing. A few years ago, it was when they stopped increasing the interest rates, when they started lowering them a little bit. Here we had stocks going up, up, and up, repo transaction, pushing more money. So the markets are driven by central bankers. That's something we have to keep in mind. However, we are still talking about low returns, inadequate returns relative to needs for pension fund obligations, governments, etc. So not a happy situation for Ray Dalio as he describes it. This is the key. There is a lot of unfunded debt. People are leveraging up for returns. We see real estate debt going up, government debt going up. Everybody is trying to chase that spread that's getting thinner and thinner. Much money is following a few assets, so we have seen equities, real estate really go up over the next decade. Expect volatility on the basis of uncertainty, as nobody knows how the economy will look like in the next 6 months and even years. We have monetary policy free, expect more and more money printing, and new allocation of capital depending on the political situation, which we'll discuss in a moment. The solution, according to Ray Dalio, is diversification. So in any case, excess return from assets will be low with high volatility. So diversification, according to Dalio, is even more important than ever, despite the fact that it will have a lower return. But a lower return is better than a negative return. So Ray Dalio is diversified across 180 countries, all the currencies, and many asset classes. This is because he says we don't know what's going to happen, and therefore the best answer is diversification. And you have to see how that fits you, whether you will follow Ray Dalio or not. The key with diversification is risk management, which is volatility, according to Dalio. According to Munger and Buffett, it's permanent capital loss, which is again another story. But for now, let's stick with Ray Dalio. So diversification is his solution, owning a little bit of everything. So when you're diversified, you own a little bit of everything, you look at what happens with that volatility, and then you rebalance, which is Ray Dalio's situation. When something goes up, he buys the less risky. This becomes more risky. And that's a lot of work. I don't think a retail investor can hold 50 or 100 assets across currencies across the globe. It takes a lot of work. And it's completely different than what we have been preaching on this channel, which is investing in a few businesses, getting those cash streams, or letting the business compound. And that's really the difference between Ray Dalio and Warren Buffett. Ray Dalio, as he says in his book, is playing the markets, not an investor. He is always playing, always balancing between what the markets do. And also that's a perspective you have to keep in mind when discussing Ray Dalio. The alarm for the market is that most of the world is in equities, and actually in one country, which is the United States of America. So 50% of the global market capitalization is in one country. We don't know whether there will be reflation, the central bank printing money and buying assets. Will that drive stocks up? We don't know how much. Will gold go up? We also don't know. Money value down, how much will it go down? That's also something that's a big unknown at the moment. And then also on the current environment investing, we have had ideal investing conditions since 1945. So we have had a great time for 70 years as investors, especially in the United States. And this is what is going to change. So we have to invest in a new environment. The three key takeaways for long-term outlook from different perspective is that there will be a lot of money printing, monetary policy free. There are increasing gaps in wealth, value, political issues with a bad economy, especially those become bigger when there is a bad economy. Corporate, individual, and capital gain taxes will likely change in the long term depending on what happens on the political situation, but globally will change. And then we have the wars. We are now in a trade war, technology war, geopolitical war, and also capital war between the old powers of the world, the developed countries, and the emerging markets led by China. This is the situation that one has to think about when it comes to investing. I'm personally trying to get the tailwinds of this, but that's also something that is different than what Ray Dalio is discussing. So my opinion on Ray Dalio is he is doing a service to really rich people that don't like volatility. They want safety, and he's doing anything he can to balance that, not to have those ups and downs of the market. That's not investing, that's hedging, trading, speculating, playing the markets and trying to get a return everywhere. So asset class returns, as he is saying, will be low, so he's preparing himself for low returns, perhaps a little bit higher, but with high volatility. As retail investors, I think we have to go completely the opposite way. We have to find investments that will do well no matter what happens, great businesses, and take advantage of the volatility. I really hope we get more chances like we had in March this year with low prices, really low prices of some stocks, some great businesses that will surely, most likely do well over the long term. So you have to see whether you are a speculator trader like Ray Dalio and whether that is a sustainable strategy for you? If it is, then you have to be diversified across the globe. You might want to look at stocks in Austria. I'll put a link on my latest research that I'm doing on Austria, the complete Austrian stock market, where you can find diversification if you are aiming for that. Me, in the specific, I'm looking for great businesses, and if you're looking for great businesses, a value investing mindset that doesn't look that much at the macro, but looks at the macro and just to see, confirm that I have to look at the micro and find those great businesses, then subscribe to this channel and click that notification bell. That's what we do. We analyze businesses, we try to find a few businesses to follow and hopefully find a few great investments each year or every few years. In life, you just need 5 great investments. That's it. That's what my focus is, and that's also the mentality on this channel. Perhaps you can do both. You can be well diversified and then find a few of those great investments. So to sum up, a lot is going to happen over the next decade. It's impossible to know what, and especially the magnitude of what is going to happen. Low real returns are to be expected because of the low spreads, the high competition, the high liquidity in the markets chasing the few assets out there. We discussed Nike stock with 1% dividend yield, but there will also be a lot of volatility because of the situation, because of the monetary reactions. And as investors, we have to embrace the volatility and take advantage of the market when the opportunity is there. This would be my conclusion from Ray Dalio's discussion. Thank you for watching, looking forward to your comments, and I'll see you in the next video.